This Chapter 3 reviews covenants that relate to a borrower's financial leverage, debt service ratios, and other indicators of creditworthiness. The most common financial covenants, perhaps, are those that limit a borrower's leverage or impose on it a minimum ratio for interest coverage. As a borrower approaches its leverage limit, assuming it, for example, to center around the debt-to-equity ratio, any form of funding that does not constitute debt, including many of the strategies already discussed, become relevant once again. Prepaid forward sales, sale and leasebacks, monetizations of portfolio securities through sale and total return swap, and so on. In addition, a wide spectrum of securities falling outside the scope of this module, known as hybrid capital, offer the possibility of raising funds in a cost-efficient, after-tax manner, while receiving from accountants and rating agencies equity treatment, either in whole or in part. Debt service coverage ratios generally divide the borrower's cash flow, or EBIT, or EBITDA, by the interest cost on the borrower's aggregate debt. Pressures on these ratios may be alleviated in the following ways. A borrower with fixed-rate debt in a steep curve environment can, of course, swap the debt into floating and ride down the curve steepness, although at the risk of deferring into the future a problem of a larger magnitude. At the minimum, the transaction gives the borrower some breathing room, whether to reduce debt service costs via a recapitalization or to improve revenues through its business process. Of course, a legal opinion is required to confirm, for purposes of the affected covenant, that measurement of aggregate interest cost takes the swap benefits into account. If swap payments are not included in the measurement of aggregate interest cost, the reverse logic may solve the borrower's problem. A refinancing of an underlying debt from a high-yielding currency into a lower-yielding one, accompanied, if desired, with a cross-currency swap to recreate a synthetic liability in the original currency, reduces aggregate interest costs and improves the relevant ratio. When hedges are included in the measurement of interest costs, a borrower should also consider strategies that subsidize the interest cost under the hedge via short embedded optionality. Examples include swaps extendable at the dealer's option, or swaps whose notional may be increased at the dealer's option, or swaps whose currency of settlement may be converted from one currency into another, again at the dealer's option. We complete this chapter by discussing a borrower's ability to lower debt service costs by converting unrealized FX gains under an outstanding debt into diminished payments of interest. This returns us to the controversial transactions implemented by Greece and Italy to lower their debt service, and ultimately, therefore, their ratio of budget deficit to GDP prior to joining the single currency. We illustrate these in a simplified manner by assuming that euro-dollar stands at 1, that the yield curves in both currencies are flat at 5%, that the borrower issues a $1,000 5-year bond at 5%, paying coupons annually, and finally that 1 moment later, euro-dollar spot rises to 125, giving the borrower a large unrealized gain on the bond from the currency translation. Suppose the borrower now decides to convert the currency risk of the bond's coupons and principal from dollars into euros via a cross-currency swap to create a synthetic liability in euros. Normally, the notional amounts of the cross-currency swap would be set at pricing to have equal value based on the current spot, i.e. $1,000 versus 800 euros. And the annual exchanges of coupons would then involve delivery by the borrower of 40 euros against receipt of $50, with which the borrower would pay the bond's coupons. The PV of these two sets of cash flows, each discounted at 5%, would be equal, and the swap therefore would have a present value of 0, exactly as required. The annual swap outflows of 40 euros would appear in the borrower's debt service total for the year. But at maturity, the borrower would exchange the notional of 800 euros against $1,000 to repay the bond principal. Having received the equivalent at inception of 1,000 euros, repayment of only 800 euros at maturity reflects the gain the borrower achieves given the dollar's fall since the bond was issued. Suppose now that the currency swap is structured instead to have a notional of 1,000 in both currencies, in order to match the initial exchange when the currencies traded at parity. To maintain the equivalence between the PVs of the two legs, a reduction in the euro coupon payments would now be required, which will be shown in a second in a spreadsheet to reduce annual coupons in euros from our previous 40 euros to only 3.8 euros, i.e. only 0.38% of the original notional of 1,000, in effect virtually eliminating the borrower's debt service cost. The worksheet appearing now, which in our rigorous tradition of political correctness we label the Corleone swap in recognition of its proud heritage, summarizes these numbers and confirms the present value equivalence when the euro coupon is 0.38%. Columns B, C, and D are self-explanatory. Column E lists the cash flows in US dollars received by the borrower under the swap, with PVs appearing in column F. Column G lists the cash flows in euros the borrower pays under the swap, assuming first it is structured the normal way, with PVs appearing in column H. Cells F15 and H15 sum the PVs in their respective currencies, and cells F16 and H16 confirm their equivalence in US dollars. Finally, columns I and J list the cash flows in euros and their PVs respectively, but this time under the Corleone swap. So a notional of 1,000 euros in cell I13 is substituted for the previous 800 euros in cell G13. And the sum of the PVs appear in these two cells here, J15 and J16, converting in US dollars, matching those that we had previously. The 0.38% annual coupon is readily confirmed from the cash flows in column I. We bring to the attention of any Greek listeners that an alternative version of this video is available, in which we have replaced the Corleone swap with the Zorba swap. In all respects, identical to the Corleone swap, except for its name. We did not think it is our business to determine which country deserves the credit for such creative financial engineering, and hope that via this solution we can keep all parties happy. We complete this chapter 3 by discussing briefly covenants which monitor the borrower's so-called current ratio or quick ratio. Without delving into definitions of these in any great detail, we can view these covenants as addressing the borrower's liquidity rather than its solvency or debt servicing capability. Short-term debt and accounts payable must be paid from short-term or liquid assets. So lenders often impose tests via covenants that compare short-term debt and payables to short-term assets, forcing borrowers to invest much of their liquidity in securities with a short tenor. In steep curve environments, this means the borrower must forego significant yield on these assets, for which an obvious possibility is to keep tenor short but ride up the curve via an interest rate swap. By doing this, the borrower is able to lengthen the economic duration of his portfolio to the desired point on the curve while maintaining liquidity as required under the covenant. This completes this chapter 3 as well as this entire module.